Happy Friday, everyone. I'm back and I'm also ready for the weekend. I know you are too. It's been an eventful week, so let's get into it.
We interrupt this important message to bring you another important message. Angel alert! I can't wait to meet you all at the Morgan Rocks event. Join us on Thursday, October 27th in Santa Monica, and I'll show you why top agents like Jason Oppenheim of Selling Sunset are falling in love with Morgan. The event's free, but space is limited, so register today at swmc.com/MorganRocks. See you there.
Thanks for joining me today for the October Weekly Market Insight Series coming from the Capital Markets Trading Desk at SunWest Mortgage Company. The week's theme is headwinds from inflation, risk to the economy, and hawkish central banks continuing to confront investors. So the ongoing earnings season did offer investors the opportunity to focus on the actual earnings power of corporate America and less on the backward-looking economic data stream. However, the few bright spots on the corporate earning reports were not proven to be enough to maintain this week's rally. The equities ascent fizzled really quickly on concern over the coming hit to consumer wallets from surging energy prices, mortgage costs, and an approaching U.S. recession. Elsewhere in the commodity markets, President Joe Biden announced the drawdown of an additional 15 million barrels of oil from U.S. emergency reserves to control the oil prices. West Texas Intermediate futures have climbed a little over $85 a barrel. Gold rose on weakness in the U.S. dollar. Bitcoin futures extended the gains after the dramatic reversal following the U.S. CPI data last week. The brief dip for Bitcoin to below 18,000 reversed sharply to trade around 19,200. So, what else is under the surface? The headline CPI report did fall back slightly in September from 8.3 to 8.2, but the more telling measure of core inflation, which excludes the cost of food and energy, reached the highest rate in 40 years, rising from 6.3 to 6.6. The message is clear. Far from relaxing its recent pace of monetary tightening, the Fed might have to raise interest rates faster and further than expected. The Federal Reserve Bank of New York's General Business Conditions Index fell nearly 8 points to minus 9.1 in October. Just so you know, a reading below zero indicates contraction. Meanwhile, the U.S. factory production rose 0.4% for a third month in September, suggesting firm growth in manufacturing, underpinned by solid business investment and demand for consumer goods. The U.S. economy grew at a 5.7% pace in the final quarter of 2021 compared with the fourth quarter in 2020, suggesting that the economy was above its longer run trend by even more than initially thought. Initial unemployment claims unexpectedly declined by 12,000 to 214,000, a three-week low, indicating firm labor demand for workers despite concerns about the economy. Elsewhere around the world, Liz Truss announced she was stepping down as UK Prime Minister. China may ease some COVID rules, a policy that has weighed on its economy and energy demand. So let's see how the housing market is doing, shall we? The housing market presents the clearest evidence so far that the Fed's policies are working their way through the economy. Mortgage rates have skyrocketed to the highest in 20 years, sapping demand that's starting to filter through to slower home price growth. Mortgage application activity fell again during the week ending October 14th as mortgage interest rates hit their highest level in 20 years. The Market Bankers Association index decreased 4.5%. The refinance index dropped 7% week over week, and the purchase index was down by 4% from 1 week earlier. Meanwhile, the new U.S. home construction declined in September and permit applications for single-family dwellings fell. Residential start decreased 8.1% last month to a 1.44 million annualized rate. Okay. Woo! So with that said, everybody, let's wrap it up. There's no doubt that the outlook for consumer prices in the U.S. continues to fuel bets that the Federal Reserve may make jumbo rate hikes at its next two meetings. Fed officials in their latest comments suggested they were ready to hike rates higher than previously planned. Kansas City Fed President Esther George said the terminal rate may need to be higher to cool prices. San Francisco's Fed's Mary Daly said she's very supportive of raising rates to restrictive levels, which most likely would increase between 4.5% and 5%. In spite of all of this, investors are still a bit optimistic about the U.S. economy and its prospects to emerge as a relative winner for the current global turmoil. Many investors also see the Federal Reserve likely being the first to halt its rate hikes, which would allow its economy and assets to recover ahead of other nations. So, yes, I'm done. That's all for this week, but I promise you, if you stick with me, I will continue to give you the latest updates because Buffy will always be there for you. Please join me again next week for more market updates, figures of various important economic data, updated status on geopolitical nervousness, and much more. So stay updated with our news, and our trading desk will keep you informed with pricing incentives. Happy Friday, my friends, and have a great weekend. Buffy out.